Absolutely. You know, it's interesting right now, and Scott, we've talked about this for months. I said it was going to be a slow melt up, and that's what we're seeing. It probably could have been an even faster rally. We might be at a 28,000 at some point on the Dow if we didn't have some of the trade rhetoric and some of the other things happening, because ultimately we're seeing GDP, we're seeing the economy doing incredibly well, record buybacks, we're seeing M&A coming back into the marketplace. I mean, this market right now is doing incredibly well because the economy is doing incredibly well. Right. The fundamentals of companies are doing incredibly well, and the companies that are guiding higher are the ones also being rewarded for that right now.
So, Josh, the issue of trade, Kourtney brings up, and the other issue that's hanging over the market, too, is rates, right? How much of a risk are those two factors as we approach a record on the S&P and then perhaps, you know, even exceed that and go farther?
Look, I think all of the risks that people are citing on a regular basis, they're not like outlandish. They're all reasonable things to point out. But I think it's important to say that these risks always exist. And if they didn't, there would be different risks and we would be talking about something else. It's also instructive to remember that the same people who repeatedly trot out these risks, especially when it comes to the Fed, were telling you for 10 years, 9 years, the entire period of the recovery, the Fed is out of ammunition. The Fed is pushing on a string. The Fed is trapped. The Fed is boxed in. Meanwhile, we had the taper, no problem. Then we had maturities not being replaced, no problem. Then we started rate hikes about a year and a half ago. No problem so far. Very gradual. Everything the Fed said they would do, they've done. Data dependent, so check. So it's not that they're not legitimate risks. It's not that the Fed might not go too far. I acknowledge that this is possible, of course. However, can you wait for it to happen?
Well, maybe that's bred some, Steph, complacency in the market, whereas nothing seems to matter to this resilient market. It's trade one day. OK, the market goes down a day.
Scott, we had a 12% correction 6 months ago. It's not true.
Sector rotations,
yeah, that was 6 months ago.
OK, so there's no complacency. The minute we get nervous, the market sells off. It should. That's how markets work. There is still fear. It's not 100% greed. And as evidence of that, by the way, you can find plenty of one-day examples throughout the course of this year, not last year, but this year, where you've had 1% down days,
fear in January.
90% down days.
There was no fear in the market in January. The market went up unabated in January.
January 26th began a 12% peak-to-trough correction
for the
S&P.
That's right, because of the way that the market ran up throughout January.
Here's the deal. 68% of the S&P 500 is now back above its 200-day. The RSI is still under 70. We still have room. We're not overbought technically, and we're about to print a fresh record high on the S&P, maybe even during this hour.
Right. And the market, Steph, doesn't seem to really be all that worried about rates going up, trade issues still there, right?
Well, we hear about it all the time. I think people are worried about it, but it doesn't seem to be impacting earnings, and that's what stocks follow. If earnings are going higher, the market's going higher. The thing about this year has been all about rotation, and that's what's propped the market and kind of supported the market at times. So when the market was going down in January, you had certainly some of the defensive starting to help, and also growth and FANG helped to support the market. And then you got through that, and then actually you did see a little bit more broadening. You saw financials start to do better. Right now, it's been kind of a strange last couple of weeks, I think, because staples and telecom utilities have been the leaders. So I'm kind of actually happy to see today you're seeing what I think is the right leadership if you're going to see new highs, which is industrials, energy, financials, and that sort of thing. But it goes back to earnings, Scott. I don't think they're going to fall off a cliff.
No, look, Tony Dwyer,
that's important.
Tony Dwyer of Canaccord believes in what you believe. He said the focus is still on a ramp in the market because it's going to be driven by earnings. 3,200 is where he thinks we go on the S&P. And it doesn't seem all that outlandish.
85% of the companies have actually beat. 85% have beaten on earnings. 75% have beat on the bottom line. And I don't want to hear that they always do. It's always 70% or something like that. 85% beating is a very big deal, and it's guidance that has been actually very, very strong.
The simple math tells you it's not outlandish, all right? If you get $175, $180 a share on the S&P 500, and to Steph's point, with the earnings that are coming up, that's not a reach. Put an 18 times multiple on that. You get to 3,200. 18 times is a little less than where we were at the end of January. And by no means, look, we're not going to call it cheap, but by no means are we going to call that a blow off top. Scott, one of the things you've asked twice, and I don't think you've gotten an answer to, is what about rates? And the answer is, where we are with the 10-year right now, actually you want to see it move higher. You want to stop this discussion of the 2 to 10-year spread, yield curve flattening, yield curve inverting. That's been on a lot of people's minds recently. You want to take away from that. So if you get another 30 basis points rise in the 10-year, get it to 3.25, then we stop talking about that, and that is not enough to upset this market.
The question is, Kourtney, what if you get more than that? Right? When someone like Jamie Dimon's out yesterday saying, look, rates should be at 4%, and you better get it into your head that it's going to be a 4 to 5% world in the not too distant future.
Well, I will tell you, I spoke with our bond desk at Loop Capital just this morning. And I mean, when you look at the auctions that are going off this week, that's where you're seeing kind of the slight steepening here of the yield curve. We expect it to flatten out, though, next week. And with the Fed being as transparent as it has been, let's be clear, they've said what they're going to do. They've done it. And the bond market, I think it's at somewhere like 90% right now, believe that in September they're going to hike. And more than likely again in December. So we'll get to 2 more rate hikes this year.
That's what I'm not so sure about.
If it goes dramatically higher than that, it may be slightly problematic. But again, the Fed will continue to signal. They've not thrown us any curveballs or surprises heretofore. So why do we think that's going to happen now?